European markets are a bit calmer this Friday morning as hopes of a diplomatic solution in the Middle East have risen. Markets are breathing something of a sigh of relief after President Trump said he would decide in the next 2 weeks whether to join Israel's war against Iran, sparking some hope that the US might still be trying to find a diplomatic solution. European foreign ministers meet their Iranian counterpart in Geneva later today, after a week that has seen some wild swings in the oil price as investors worried the conflict could spread. Chris Beecham is chief market analyst at IG. Chris, this week illustrates investors are nervous at the moment, aren't they?
Yes, it does really. Given the size of the rebound you've had since April, there's a lot of sense of where do we go from here? We're waiting nervously for data. The fact that recent data from the US that has shown that maybe inflation isn't really feeding through from tariffs yet hasn't caused a major market surge, suggests that the market's just waiting for something more, or indeed waiting for something worse, if you like. And obviously last week's developments in the Middle East came out of most surprise, really, and did cause a bit of a reaction. But it does feel like this market is still in a wait and see mode. It's just, okay, we've rallied quite a lot, and stocks aren't as cheap as they were 2 months ago at those April lows. But what is going to drive us high? What is the good news? Is there going to be good news? At the moment, we're just not quite sure where that's going to come from.
In the UK, we had a surprisingly weak retail sales number this morning. Should the market be worrying about consumers' weakening appetite to spend, do you think?
Well, one is a blip, but two might be a trend. And I think this is the key thing to worry about with retail sales, that if it starts really to move into a more sustained downward pattern, this is the biggest loss we've had in retail sales all year, really, and certainly for about a year, then I think there's more sustained grounds for worry. Of course, you add that to the picture of employment looking quite weak, then yes, there are signs that the Bank of England may well have to move. Well, we know it's likely to move anyway, but perhaps it will have to move more quickly than anticipated in order to try and support the economy. And I think you're also seeing that in reaction from Barclays Group's numbers this morning, down originally 9%, really, worrying that the rosier outlook from the company isn't really matched by what we're seeing in the UK economy at the moment.
We've also seen higher public borrowing. Is this something that should concern Rachel Reeves and indeed the bond market?
Not excessively, I don't think. It's not much above what we're expecting. I think it's still within the realm of acceptability, really. This government, I mean, its popularity hasn't been great, but it's certainly got the messaging right for the bond market to say we're not planning to sort of run the book on public finances too much, and we do expect tax rises in the autumn. So the reaction has been fairly muted. Certainly sterling holding up quite well. That's partly, I think, or no small part down to dollar weakness. And you wonder how long sterling can stay up here against the US dollar, given the uncertainty around the UK economy. But for the moment, it's holding up relatively well. And that's at least a positive sign for the government itself.
We did, though, see quite cautious commentary from the Bank of England this week. What did you make of that?
Well, I think it's understandable given the position they find themselves in, and obviously with the developments in the Middle East over the past week, things have got harder. If you do have sustained US intervention, you'll probably see oil prices continue to move higher, and that makes their life more difficult on the inflation front. But of course, with that deteriorating unemployment picture, I think there are concerns that they might just have to be a bit more aggressive on the rate cutting front. But we'll have to wait and see, really. Unfortunately, all central banks are stuck in this mode at the moment, and we'll just wait and see how the situation plays out in the Middle East, how it affects the oil price, and if it really does begin to give a lift to inflation, and then their job gets even harder than it is now.
When you say they might have to be a bit more aggressive, was the bank right to hold rates for now?
I think so. I think you have to be wary of moving too quickly and then suddenly having to reverse course if inflation starts to spike again. It already remains above target. So it would look hard, I think, to justify the move, even with the weakening picture in other parts of the economy. But certainly it is beginning to tilt, I think, more towards rate cuts as we head towards the second half of the year and beyond.
Given, of course, the conflict in the Middle East, could another rise in energy prices throw that off course?
Yes, it's the big wild card really here. How quickly does oil move higher? How sustained is it? The other questions rapidly come into play here in terms of OPEC, who've been looking for an excuse to increase production. This might give it to them. If you get US intervention and a spike in oil further towards $80, then it might not be as dramatic as expected. But certainly, yes, I think if you do start to see inflation pick up again because of a rise in petrol prices, that will hurt consumer spending and really boost calls for the Bank of England to do something quickly just to help consumers in whatever way it can.
That was Chris Beecham of IG. Don't forget, you can watch more videos on Reuters.com.